Good morning, everyone. I am Evan Freeman, Director of Government Relations for EPB, and we're so excited to have Curtis Dubay. He's the Chief Economist of the U.S. Chamber of Commerce. Very excited to have him with us today. A little bit about Curtis. He tracks the condition of the economy, analyzes the impact of public policy on economic growth, and runs the Chamber's Chief Economists Committee. Previously, he was Senior Economist at the American Bankers Association and a research fellow in tax and economic policy at the Heritage Foundation. He's also worked with the accounting firm PricewaterhouseCoopers and at the Tax Foundation. Dubay received his master's degree in economics from the University of Connecticut and his bachelor's degree in economics and leadership studies from the University of Richmond. He resides in Washington, D.C. with his wife and 3 children. Curtis, welcome to the panel today.
Glad to be here. Thanks, Evan.
Yeah, we'll jump right in on some questions. There seems to be a lot of conflicting information going on about, are we in a bad economy? Is inflation, with it being at 40-year high right now, are we in a recession? What could you give us just a breakdown of what you think the economy is right now?
Yeah, of course. We are in a really interesting time because the data isn't clear on what's going on. And it's really unique in the sense that we're coming out of a global pandemic and everything that occurred during that, the ramifications from those things are still occurring now throughout the economy. So let's step back and go and talk about what everyone's talking about for a while now is whether we're in a recession or not. A recession, a textbook definition of recession. So for those of us who took economics, it says there in the textbook that a recession is 2 consecutive quarters of negative economic growth. What that means is that the economy contracted for 2 consecutive quarters. We had that. That happened. The first quarter growth was negative. The second quarter growth was negative. So we've met that criteria. The thing is, though, when you have a recession, usually things like jobs are decreasing, incomes are falling, spending's falling, manufacturing output's falling. And those classifications are those, what's going on with those factors weighs in on, there's a committee at the National Bureau of Economic Research that most people look to for determining when a recession occurs. They look at those factors as well. You have a normal recession, those things fall. It's not that complicated. This is different. All those indicators, jobs grew at 528,000 jobs last month in July. Incomes held up pretty well. Consumer spending is holding up pretty well. Manufacturing output is growing. So those things are not coming together. They're going in different directions they normally would. So calling what happened in the first part of the year a recession isn't as clear cut as it normally would be. Now, all that said, does it really matter whether we're in a recession or not? Consumers feel bad about the economy. Their budgets are being squeezed heavily because of inflation. And it's not just that inflation's at around 9%, well, it's 8.5% as of July. It's that food prices grew at 11%. Gas prices are up 44% over a year ago. So things that they have to buy are really squeezing their budgets. That's why consumer sentiment's at a 40-year low. So that's why I'm not too concerned about whether we're in a recession or not. And the other reason why I'm not too concerned is that that's retrospective, looking backwards. That was the first and second quarter of the year. We're now well into the third quarter. We're likely growing now. We're anticipating growth being 2% here in the third quarter, and that means the recession would have ended. So whether it was a recession or not, if it turns out that it was, it doesn't mean that things were any worse for businesses or for businesses and for consumers. It doesn't change anything. It doesn't really matter whether we're in a recession or not. And businesses, it matters a lot for businesses as well. When it comes to inflation, but the recession designation doesn't change any facts on the ground.
Okay. Yeah, and there's been a lot of talk about inflation. Could you give your thoughts on what are some of the drivers for the inflation right now?
Sure, inflation it's a new, for a lot of us, it's a new thing to look at and study. We've had a 40-year period where inflation was low. It's called the Great Moderation. It went on from 1982, when the last round of major inflation we had ended, right and through till March of 2021. The cause of inflation there's a lot of them, but the main one is monetary policy. And I'll get into that in a second, but let's take off the other things that are driving up prices as well. So things like the supply chain shortages, there's a scarcity of goods and there's a lot of demand in the economy that will drive up prices. It's particularly driving up prices in really specific pockets like cars. We couldn't get cars off the assembly lines. That was driving up the price of new cars, but it was also driving up the price of used cars. And there was all sorts of examples like that throughout the economy. So supply chain issues mattered. Workforce shortages mattered a great deal because employers had to pay workers more and more to come off the sidelines, to come to work, and to keep them there once they had them employed. So that was pushing up prices as well. All that was also happening when there was a tremendous amount of demand in the economy. We were coming off of COVID. The economy was opening up. Consumers had a lot of money saved up. At one point, it was $2.8 trillion in excess savings. So $2.8 trillion above what we would have saved was in consumers' pockets from March of 2020 through the earlier part of this year. It's come down a little bit, but there's still $2.5 trillion in excess savings in the economy. So there's a lot of money to be spent. So demand was going up, supply was constrained. That was driving prices higher. Those factors all matter. But when it comes at the end of the day, inflation, I subscribe to the view that, and this is an old Milton Friedman saying, that inflation is everywhere and always a monetary phenomenon. And that means that comes from the Federal Reserve's, what they do with the money supply. They substantially increased the money supply in the post-COVID world. Over $6 trillion of increase in the money supply, which translates into higher prices because you end up with too many dollars facing too few goods. And that's particularly the case when you have a constraint on the supply side. So it's the monetary issues that are really driving prices up. The other issues matter as well. We'd probably have inflation instead of being at 8.5%, maybe it's down closer to 7 or 6. It's still really high, and that's coming from the monetary side. So that's why the Fed is now shifting into a anti-inflationary policy stance. They're raising interest rates that will help to bring prices down over time. There are lags. It takes a while for inflation to come down. It takes a while for monetary policy to work. We're going to have high inflation through 2024 minimum. And when I say high inflation, it's going to be above the Fed's 2% target. So we're in for a rocky couple of years when it comes to inflation. There's been some good news. It's cooled here in July. It's welcome, but we're still way, way above 2%. And so we still have a ways to go. I am hopeful that we can see inflation in the 7% range before the end of the year. And that's because when it comes to inflation, psychological factors matter a great deal. And it comes down to expectations for inflation. So if we all expect inflation to be lower in the future, so prices to come down, we might delay certain important purchases. So like, for instance, my refrigerator has been driving me nuts. I want to get a new one. And I want to hold out, besides the fact that the supply chain issues, but maybe prices come down in 6 months or a year. So maybe I can get it cheaper then. There's a whole lot of people making similar calculations, delaying purchases until prices come down a little bit. That reduces demand today and brings down prices in the immediate term. So the hope is that that can have an impact before the end of the year and get inflation down closer to 7%, which is the Fed's estimate before the end of the year. And there is some signs that could work. Long-term inflation expectations remain, economists and analysts say, anchored, but they remain, when you look at long-term inflation expectations, they're right around 2%, a little above that. So that means that the psychological factors, the expectations can work in a more effective way in a shorter period of time.
Okay. Yes, it's very interesting. You mentioned the workforce and talked about job numbers for July. Do you think that's a trend that's going to continue to get better? I know, with all the changes of how, the workplace is perceived after COVID, do you see more the job numbers growing going forward?
It's a really interesting question because we had a totally unexpected huge job creation number in July. The economy added 528,000 jobs. Now, here's the thing. There are two numbers that go into the survey that comes out the first Friday of every month. One is called, it's a survey of businesses, and that's what the number that most people look at, and that's the one that added 528,000 jobs. There's also a survey as part of that report that looks at households. It surveys individuals. Now, job growth on that side was only 179,000, much lower than the big top line number. This doesn't usually come up because they're usually the same, or they're usually very close. It's very unusual to have them off by 400,000 jobs. I don't know what's going on. At some point, they kind of have to converge and come together. Again, back to what I said at the top, we're in a very unique, different economic environment, and we're getting these kind of one-off or unusual data points, and this is certainly one of them. So I absolutely do not expect the economy to continue to add over 500,000 jobs each month. That said, I do think we can continue to add jobs at a decent clip, which again complicates the call for a recession now and going forward if we're adding jobs. But the reason why I think we could even add jobs, even if we are into a recession, certainly not 500,000, but we can continue to add, is because businesses are so far behind when it comes to hiring. They can't meet the demand they have now with the workforce they have. They can't meet a reduced amount of demand with the workers they have. And so they know that they need to get those workers, and they're willing to pay them and keep them on staff, on the payroll, even if things are slowing down, because they know that when things ramp back up, they're going to need them there to provide their goods and services. So I am hopeful that the job creation number will remain at least positive, if not as robust as it's been the early part of this year. But it could remain positive, which again is a unique circumstance.
And you do a good job of explaining kind of, you know, the unknown variables that are out there that's yet to see. One big thing that's been affecting our economy, at least you know, perception wise, and the conversations a lot, you know, shifting to the global aspect, is what's happening in Ukraine with the war at Ukraine and Russia. And there's a lot of tensions between China and Taiwan, you know, that's been there for a while, but starting to come to the forefront. How do you think that's impacting our economy? I know from the energy side, that's something we were very mindful of, and know that has been an impact, especially the way as a country that we view energy and energy policy going forward. What are your thoughts on how that's affected inflation and our economy?
Yeah, let's take this in three buckets. The first is global uncertainty. Geopolitical uncertainty is always a problem, and it always creates issues in the economy because it creates uncertainty. Businesses hate uncertainty, and it causes them to hold back on planning and making key investment decisions. It also can disrupt important inputs, like we see with Russia and Ukraine, and that comes with energy, food, fertilizer, things, and basic elements, basic commodities that come out of Russia and Ukraine. It disrupts the global supply chain. So businesses, financial markets, they do not like geopolitical instability. So it's always an issue to keep an eye out for. China and Taiwan is different than Ukraine and Russia. China and Taiwan will be extremely disruptive for the global economy because China is such a major player in the global economy and such an integrated part of our economy. So it's certainly something to watch. I would not use Russia and Ukraine as an example for it because the factors are so different. And we are tied pretty closer to Taiwan than we are to Ukraine. And so that will be much more central to that potential conflict. So that's the second one. The third one is Russia and Ukraine. It's a problem, and it's going to remain a problem. It's putting upward pressure on energy prices still. It's making food more scarce, which is pushing up food prices around the country. Like I said earlier, our food prices have gone up 11% annually. They're still well above the headline inflation number and still really chewing up our budgets. That is in part, that is an issue with energy, in part an issue with Ukraine. These are global markets for commodities, whether it's wheat or any other type of basic food stuff. Prices going up because there's a scarcity because Ukraine is such a major producer means our prices go up as well. But it also could create more geopolitical instability because it's not just that prices are going up, it's that supply is constrained and there could be food shortages around the globe. So definitely keep an eye on that. And then any of the commodities that come out of Russia, we saw a big issue with nickel earlier this year. The price spiked because they couldn't get it out of Russia. Things are adjusting, but it still matters a great deal. And I think fertilizer will be one of the issues that crops up. So we're keeping a close eye on this, and it's always worth keeping a close eye on. I'm hopeful that things settle down and that we can proceed. But again, it's definitely worth keeping an eye on.
Moving over to policy in DC a little bit, the Democrats recently passed the Inflation Reduction Act. What do you think the impact of that would be? Do you think it reins in inflation?
No. In what world does the government spending more money reduce inflation? They had a lot of chutzpah to name it that. I will not call it that. I'll call it the reconciliation bill because I think it's an affront to all our intelligence. No, it's not gonna rein in inflation. That's the bad news. The good news is I don't think it will push up inflation too much because the spending comes kind of later. So I don't think it's going to have a big impact now. The problem is the missed opportunity, and that what I talked about earlier is that the Fed is the real central player when it comes to bringing down inflation, and that's absolutely true. But Congress and the president, they do play a role when it comes to inflation. They hold some of the responsibility for the high rate of inflation. If you look at charts, and by the way, I have a slide deck with all sorts of data, and every chart has a analysis on it. Lots on inflation. You're welcome to it. It's a resource for chamber members and businesses. So please, I can send it on, and you can have that. But it's the Fed. The Fed has a central role, but if you look at when inflation really took off, it was March of 2021. It just happens to coincide with the last big COVID stimulus bill. It was another $2 trillion spent. Those were checks to individuals, and inflation started taking off, and spending took off, and right at that time. So what the fiscal side can do, fiscal being Congress and the president, is to not make things worse. A lot of the ramp of inflation was because of all that fiscal stimulus. But they're making it worse by spending more, and they're also missing out on chances to reduce inflation. So the three things that they can do are to help bring energy prices down by encouraging production. The administration is not doing that. The Biden administration is not doing that. Congress is not doing that. They can reduce tariffs. That would have an immediate impact on prices. They're not doing that, and they could help on the workforce side. They could help with bringing in more skilled immigrants, make immigration easier to get the workers we need to get that will help bring the wage pressure down. None of those things are happening. They're instead going the opposite direction and passing policies that will ultimately make things worse.
Yeah, and a lot of the times, a lot of the names of those bills can be misleading and very political out there. A lot of our audience that are businesses that are faced with the uncertainties that you talked about, the supply chain, and just how that's disrupted the market. The workforce and the long list of issues that are out there and uncertainties. But could you talk about a little things that you and the U.S. Chamber are doing to sort of help combat that, and maybe some things that some of the businesses here in Chattanooga could do?
Yeah, absolutely. So we're always looking at what legislative we can do to improve economic growth. And I think given our unique circumstances that we're in right now, I think the key thing is, again, back to inflation. And so we'll likely lose out that the House will pass the Inflation Reduction Act, the badly named one, and that spending will increase, and they'll miss out on a chance to pass anti-inflationary policies. But now we're going to shift into a new reality here in Washington, which is that we're going to have a midterm election. And then we'll shift into a presidential election soon after. Usually, there's not a whole lot of legislation in the second half of a presidential term. And that means that the Biden administration will be turning towards its regulatory authority to implement its agenda. And as it does that, it is likely, or is going to add regulations that are going to put increased costs for businesses, which are going to be passed on to consumers in higher prices. So they are likely to engage on a regflation agenda. And we're now putting together a whole program of work to explain how that happens and to fight back against that. And so look for that coming in the coming weeks. And then, of course, we'll continue to fight. If they do have major bills that they're pushing that will be bad for business and bad for the economy, we'll be watching those as well.
Okay, great. And And from your perspective, first, again, I want to thank you for taking the time to talk with us, and definitely would love to have you and your family come visit Chattanooga if you haven't been. It's the best city in the world, as we like to say down here. Just from your perspective, you're in charge. What do you do to get the economy back on track?
Well, I'm glad you asked that, because the one thing I haven't said so far is what I think happens once inflation comes down. So what I think occurs is that we have high inflation, so well above 2%, until at least the end of 2024. And that means that the economy is going to be, when you have inflation is incredibly disruptive because it creates so much uncertainty for consumers and businesses and everyone in between. We're going to have a bumpy couple of years. We're going to see, let's just use the stock market as a gauge. The recent highs was over, say, 36,000. We're well below that now. It's going to take a couple of years before we sustainably get above that level. Stock market will track what's going on in the economy. We had a good month in inflation in July. We might get a bad one in August or September, and then a good one in October, and a bad one in November. It's going to bounce around. It's just the nature of inflation. But it will come down, but it's going to take a couple of years. It's after that where the good news kicks in. So 2025 and beyond, we're in really good shape. The U.S. economy, the underlying strength is there. It's just that inflation is creating that we're not enjoying the strength that comes from that. So I do think we're in for a bumpy couple of years, but I do think that we're poised for really strong growth after that. And the thing that I would do if I was in charge is I would get out of the way of the Fed, let them do what they need to do to get inflation down. Taking political pressure off them is key here, because they had to do what's right to get inflation down. But if there's a whole lot of pressure on them to stop raising interest rates because it's raising prices for whether it's homes or wherever else credit is needed, and they take their foot off the brake in this case, we could have a longer bout of inflation, and we won't get through it by the end of 2024. So that's what I would say. Let the Fed do its job. It knows what it needs to do. Let them do it, and let's get past inflation and move on to brighter days.
Okay. Well, Curtis, thank you so much again for joining us today, and good luck to you in DC.
Thanks so much. Glad to be here. Happy to do it anytime.
Thanks.